Hey, here's something you can impress your next Tinder date with. According to PepsiCo's last annual report, 58% of their sales came from food and only 42% came from beverages. What's up? I'm Russ, and I wanted to do a really super duper quick idea generation video for you. So these are not buy recommendations, and we ran a screen on Simply Safe Dividends for several quality metrics and found 10 stocks trading below either the Morningstar or the Alpha Spread fair value. I have a spreadsheet linked in the description below that's going to show you exactly where the investor relation pages are. And before we get into it, remember I have a free weekly newsletter. You can sign up below or just go to DapperDividends.com. And this is going to be really quick, so if you want to take a little bit of a deeper look-see, you're going to probably have to pause the video, as I'm only going to pull out a few quick stats while we're scrolling through the page for these on simplysafedividends.com. First up, we got Nexstar Media Group, ticker NXST. I mean, they're pretty much the king of local TV stations in the United States, and they're all about news, sports, and shows. Plus, they've got this new and independent network called News Nation, and even a radio station in Chicago.
Media Group station.
They're also in the digital space with websites and apps. They get a dividend safety score of 60, monster dividend growth, 27% 10-year CAGR. They've given a 25% raise in each of the last 10 years, currently hitting you with $6.76 of dividend income every year annually. A lot of people worried about their future, so their yield is 103% above the 5-year average. But the free cash flow payout ratio, they can easily cover the dividend. It's only 22%. Shares outstanding, they've been buying back ever since they had to issue shares to make that big Tribune Media acquisition. Pretty solid margins. Return on invested capital could be a little bit higher. They got a little bit more debt than I like, but they're a cash flow generating machine. And Morningstar gives Nexstar Media a fair value of $170. Next, we got Rexford Industrial Realty, ticker REXR. They buy, run, and improve industrial buildings in Southern California, which is a huge and busy area for businesses, and they own many buildings that are hard to replace, and they have really good tenants. They get a dividend safety score of 81, very safe, 22% 10-year CAGR. They grow the dividend very quickly, 10-year dividend growth streak, paying out $1.67 annually. Remember, they are a REIT, so that is a non-qualified dividend, meaning you will pay your ordinary income tax rate on it in a taxable account. Their dividend yield is 66% above the 5-year average. For a REIT, it's much better to look at the adjusted funds from operations for a payout ratio, which is 88%, so that's still really good for them. And their AFFO per share, which is really important for REITs, is climbing up and to the right. REITs have to pay out 90% of their profits in the form of a dividend, so the way that they grow, they're going to issue shares, but when they're issuing those shares, hopefully they're going to be making more sales and making more AFFO per share growth, which they are. Like to see that operating margin keep going up and to the right. Pretty dang low debt for a REIT, 21% net debt to capital, and they have a really nice interest coverage ratio. And Alpha Spread gives them an intrinsic value of about $56. Next up, we've got the Squibber, Bristol Myers Squibb, ticker BMY. They've been around since the 1800s, making important meds. They're big on drugs that are super specific and protected by patents, which means they're the only ones who can sell them for a time. Now, they're always researching to keep their drug game strong, especially with some big buys that they've made recently. Bristol, don't call me Mike Myers Squibb, gets a dividend safety score of 70. Simply Safe Dividends downgraded them in December of 2023 from 79 because they acquired Karuna Therapeutics for a big old price of $14 billion. 17-year dividend growth streak, 4% 20-year CAGR, but it is 7% the last 5 years, so that's nice. Uninterrupted dividends for 53 years, paying out $2.40 per share annually. Their dividend yield of 4.5% is 42% above above the 5-year average. Really low free cash flow payout ratio, so they have no trouble paying that dividend as things are right now. And it looks like their sales have pretty much leveled off since 2021, and they do slowly buy back shares, currently down to 2.08 billion shares. I don't care what Simply Safe says. I know they put the bar higher for the pharmaceutical companies, but I think that their margins look pretty solid, and I love that free cash flow margin. 28 cents of every dollar is making its way to the free cash flow. That's a little bit high, but only 50% net debt to capital, and their interest coverage ratio could be a little better, but I think it's still okay at 7.45, and Morningstar gives them a fair value of about 63 bucks. Oh, we got Hershey's, ticker HSY, which you know is the candy king, and they make all the stuff you love like Hershey's bars, Reese's, and Kisses. Plus they've got snacks like Dots pretzels that my guy Darth Dividend is addicted to. But really they're all about that chocolate life and have been doing it since the 1890s, and they even have their own amusement park. There's been some headwinds facing Hershey's with the weight loss drugs, the price of cocoa, but they have a dividend safety score of 93, very safe. 14 years dividend growth, 10% 20-year CAGR. 15% dividend raise this last February of 24. That's really sweet. Paying out $5.48 every year currently. That dividend of almost 3% is 40% above the 5-year average. Really strong company. Free cash flow payout ratio of only 59%. They still have positive sales growth going all the way back to 2016, and they very slowly buy back shares down to 206 million shares outstanding. Boom, look at those margins. Oh, that's sweet. 26% return on invested capital, 23% operating margin, 50% return on equity, and a free cash flow margin of 14%. They've been paying down debt. Their net debt to capital down to 54%, and their interest coverage ratio, that means they have $15.68 of operating income to cover every $1 of interest expense. And Morningstar gives them a fair value of $197. Come on up next, Comcast, ticker CMCSA. They are pretty much everywhere. They hook you up with internet and TV. They run some of the biggest theme parks, and they're behind a bunch of TV channels and shows. Plus, they've got the streaming service Peacock, so if you're watching something, there's a good chance that Comcast is involved somehow. Look at that, dividend safety score of 89, very safe for Comcast. 12% 10-year CAGR, raised at 6.9% in January of 2024. 15-year dividend growth streak, paying you $1.24 every year currently per share, and their dividend yield is 36% above the 5-year average. Oh, how low the free cash flow payout ratio, 37%. $3.11 of free cash flow per share can easily cover that dividend. Sales growth, okay, it's gone a little flat lately. Shares outstanding down to 4.15 billion shares. Very solid margins all across the board. 11% free cash flow margin. I think their debt's reasonable. Simply Safe things it could be lower. 54% net debt to capital, and a little bit low, $5.70 to cover every $1 of interest expense. And Morningstar gives Comcast a fair value of $60. Next up, we got Regions Financial, which is a big bank based in Alabama that was founded in 1971. They've got branches and ATMs all over the South and Midwest, and they do all the usual bank stuff like checking and savings accounts, loans, you name it. Regions Financial has a dividend safety score of 50, borderline safe. A whole lot of dividend cutting going on during the last recession, but 20% they raised that dividend in July 23, 14% 5-year CAGR, paying out 96 cents per share annually, and their dividend yield is 29% above the 5-year average. For banks, we like to look at the earnings payout ratio, so they have an earnings payout ratio of 39%, so that's in check. Although their earnings per share has been dropping just a little bit every year the last few years. Shares outstanding slowly buying them back down to 938 million. Some of the margins like return on invested capital and operating margin aren't really that meaningful for banks, as you read on the screen. Their net debt is only 14%. And Morningstar gives Regions Financial a fair value of $21. Now you may have seen them on my shirt, and it is PepsiCo, ticker PEP, which is like the big boss of snacks and drinks. I mean, they're huge, raking in billions, and they've got a bunch of stuff that people just keep buying. And you know, they're always trying to keep up up with what people want, like adding healthier, low to no sugar and reduced sodium options. And even though people are going for healthier stuff these days, PepsiCo is still killing it, and they're probably going to keep growing, especially with more people around the world getting into snacks and fizzy drinks. PepsiCo dividend safety score of 93, very safe. They are a dividend king with a 20-year CAGR of 11%, currently paying $5.42 every year, and their dividend yield is 17% above the 5-year average of 2.83%. So back in 2018, when Ramon LaGuarta came aboard as the new CEO, he wanted to really upgrade the business, started the Pep Plus thing, so they've been spending a lot more money than usual, which is why the free cash flow payout ratio is pretty elevated, hit a crescendo in 2022, but as they told me, things are going to be mellowed out now because they don't have to spend as much as they did upgrading the business, so that should start falling back in line with what it's historically been. So we should start to see that sales hopefully flatten out, and they do slowly buy back shares down to 1.38 billion. Now I like their margins, really solid return on equity, return on invested capital, and a 9% free cash flow margin, slowly paying down debt. Would love to see it a little bit lower, 67%, but they can easily cover the interest on their debt with 15.76 interest coverage ratio. And Morningstar gives PepsiCo a fair value of $180. Oh, this is a business I am familiar with. Prologis, ticker PLD. And that's because they're the big dogs of the warehouse space. Think of them as the landlords for all the places where companies make or store their stuff before shipping it to you. They got a ton of these giant warehouses all over the place, and businesses love them because they're all about the latest and greatest in logistics. Prologis has a dividend safety score of 61, safe. They had done a lot of cutting too during the GFC, but a 13% 5-year CAGR, so they've been growing that thing pretty quick the last 10 years. Again, they're a REIT, so it's a non-qualified dividend, paying $3.84 every year. Their yield, 15% above the 5-year average, almost 3%. You'd think it's a little bit low for a REIT, but they should be continuing to grow that pretty quick. Again, we check out the AFFO payout ratio. They're predicting 85% next year, so we want to keep an eye on that, but where it's at now, it's 70%, that's pretty low. And that's because their AFFO per share has leveled off and might start dropping next year. Not too crazy with their share dilution, but their AFFO and their sales are growing for the most part, right? Return on equity, return on invested capital, they look a little bit low, but again, they're a REIT. They have a low net debt to capital, only 33%, and a pretty nice interest coverage ratio. Well, I guess I'm a liar. You got me, because they're slightly over their fair value, $128. But as Warren Buffett says, a business's intrinsic value is just a range. There is no exact specific number. So I say, it's close enough. We got a small cap company next, Haverty Furniture, ticker HVT, which is all about making your home look good. And they've been selling furniture and all sorts of home stuff since the 1800s, so you can get your grubby little hands on some fancy mattresses or get a couch made just the way you like it. And you can either go to their stores or shop online to get their furniture. Haverty has a score of 50, borderline safe, but look at that really nice growth coming out of the recession, where they did cut 8% 20-year CAGR, 10% 5-year CAGR. Getting ready for another raise, probably going to be about 2 or 3 cents, currently paying $1.20 per share per year. And they did pay a special dividend at the end of the year of 2023. Now their dividend yield is about in line with their 5-year average. 45% free cash flow payout ratio. Big drop in sales growth, so that's probably because people aren't buying that much furniture right now, but one to keep on your radar. Shares outstanding down to 16.8 million. Not a lot of shares left out there. I think that's a really good return on equity of 19%, although their free cash flow margin, a little bit low, 5%, but all in all, I think it's a really interesting company you might want to take a look at. Now they have really low net debt to capital, only 25% the last 12 months. And check out that interest coverage ratio, 532.62, my. And alpha spread gives them an intrinsic value of about $40. Last we got Lockheed Martin, ticker LMT, which is the old guard of the defense world. They've been around since planes were a new thing. Now they're one of the top dogs making fighter jets and all sorts of defense gear. They're tight with the US government and have a rep for handling big complex projects. that are super important for the country's safety. And they're also big on research to stay ahead of the game. And they're a major player in keeping the peace and have been doing it for a long time. SimpliSafe gives them a safety score of 84, very safe. Now their dividend growth slowing down just a little bit, 16% 20-year CAGR. They raised it 5% in October of 23, but they've been growing it for 21 years, currently paying $12.60 per share every year, and their dividend yield is about 10% above the 5-year average. Free cash flow payout ratio, not even 50%, so that's pretty dang low. Their sales kind of flattened out a little bit since going back to 2020, but they keep buying back shares, down to 251 million outstanding. They just have such nice margins all across the board, including an 86% return on equity. Their net debt, a little bit high, 77%. But their interest coverage ratio, 9.89. And Morningstar gives Lockheed Martin an intrinsic value of about $482. So we do own Lockheed Martin and PepsiCo outright. And if you want to see what's moving and shaking in the portfolio recently, click on this floating little portfolio update video box floating right there next to my head. And if you do that, I will tell you all about it there.